Today we are looking into the specifics of an options contract. What we're going to do in this video is to lay down the foundation, which will become increasingly important as we go further into this beginner's track. Now, an options contract has 5 parts, and I am going to look at each of these one by one. This way, you will know exactly what you're looking at when you see the options contract presented to you by your broker or your trading platform. As we mentioned in previous videos, an options contract has essentially 5 parts. So let's look at a basic options contract and examine these 5 components. The first part is the underlying asset itself, the actual stock. So in our example, we are looking at the Nifty Index. However, it could be any optionable stock. It could be Tata Motors, JSW Steel, HDFC Bank, or even the Bank Nifty. And this is the basis of the options order. It's a contract. It's a part of the contract that everything else hinges on. So remember, an options contract is simply an agreement to buy or sell stocks, right? This part identifies what it is that we'll be buying or selling. The second component of an options contract is the expiration date. It's the date when the contract expires, losing any remaining extrinsic value. This could be any month or week. In our case, it's the week ending on the 3rd of August 2023. Typically, it may say, AUG 2023, indicating August 2023, or AUG 24 for August 2024. It depends on how your trading platform presents this. It's the time factor that tells you when this contract will expire. The third component is the strike price itself, the agreed price to buy or sell the underlying stock in the future. For this example, our strike price is 19,800. Now keep in mind, this is not the current trading price. Nifty may be currently trading at 20,000 per share, but our strike price for buying or selling a call option is 19,800. This price forms our future agreement, and as I like to put it, it's the price at which you strike a deal. Now, the fourth component is the type, essentially whether we're trading calls or put options. There are only 2 types of options, as you've seen before, calls or puts. You'll see whether the 19,800 strike is on the right put options or the left call options side of the options table. So on this side, you'll have the calls, and on this side, you'll have the puts. The CE here represents call equity options. And then finally, the 5th part of an options contract is the premium paid or received by either party. For instance, if you're an option buyer, you'd pay 100 rupees for this contract. If you're an option seller, you'd receive that 100 rupees for the same contract. Just to note that premiums and options contracts usually have a multiplier. In the Indian market, this depends on the underlying stock. For example, in this case, the Nifty as well as the Bank Nifty, the Nifty has a lot size of 50 units, whereas others have different lot sizes, like JSW Steel has a lot size of 1,350. So when you see a premium, it's actually multiplied by the options multiplier. The real value of that contract in this example, for instance, is 100 into 50 or 5,000 rupees. So I hope this clarifies the specifics of an options contract. As we work through more examples, it'll become easier to understand. This video is intended to establish the groundwork, building upon what we previously discussed about what an options contract is and its various components. And as we progress through this track, we'll become more detailed in discussing buying versus selling puts, buying versus selling calls, etc. Now, I hope you find these videos helpful. If you have any questions or comments, please do leave them in the comment section below.